Yeah, let's start. Yeah. All right, a very good afternoon to everyone. My name is Yen Chu Cheng, and this is Shika Jory.
Hello.
On behalf of the Asian Business Bankers Association and Oliver Wyman, we would like to welcome you to this webinar. We have nearly 100 risk officers from 17 countries and 45 different financial institutions registered, and we really hope to make this interesting and insightful session for you. So the topic of today's discussion is implications for organizations, skills, and the role of Chief Risk Officer given technology developments. So with the arrival of digital technology age, commonly referred to as the fourth industrial revolution, we're now in the midst of changes that will fundamentally transform how we live, work, and interact with one another. And this has significant implications on how the risk management function will need to evolve in order to support business functions. We have about an hour for this session. Shikha and I will try to spend approximately 45 minutes sharing with you our perspectives from our experiences working with risk organizations across the region. And if you have any questions during the presentation, please feel free to send that through the chat feature within the video itself. Right? We'll save about 15 minutes towards the end to address some of these questions. And unfortunately, we may not get to all of these questions. So if we don't get to that, we'll be very happy to separately address them with you after the presentation itself. All right. So before we start, a quick introduction to Oliver Wyman. We're one of the world's largest management and economic consulting firm, helping our clients across a range of industries and topics, including risk management for many of the largest financial services firms in the region. We are part of Marsh & McLennan Companies, a listed company on the New York Stock Exchange, which has businesses in insurance brokerage, risk management, reinsurance, as well as talent management. And these are provided by our sisters company, Marsh, Guy Carpenter, Mercer, respectively. So today what we'd like to do is to share some of our experience drawn from our consulting engagement with the CRO organizations of many of the financial services clients that we service in the region, and how we see their roles evolving in light of the current changes in technology developments. So before we start, a brief introduction. Again, my name is Yen Chu Cheng. I'm a partner in the finance and risk practice in Oliver Wyman, and I spent a large part of my career in the area of credit risk management. I also head up the labs practice in Southeast Asia, which houses the technical delivery for capabilities for our firm.
Hi, I'm Shikha. I'm a senior principal based out of our Singapore office, also dedicated to finance and risk practice. I'm a specialist in target operating model design, driving transformation, and workforce planning.
So first, to set the context for today's webinar. Now, we've seen significant changes in the financial services industry, particularly with the onset of the digital era. So when it comes to analytics, we are seeing more prevalent deployment of advanced analytical tools across the banking value chain, and everything from customer segmentation, targeting, underwriting, monitoring, early warnings, all the way to collection activities. On the data side, we're also seeing much prevalent use of alternative data, such as social media, telco data, utilities, just to name a few. The digital infrastructure is also rapidly evolving, including automation of manual processes to create efficiency and reduce cost, decentralization of IT infrastructure, and use of open platforms such as APIs in order to facilitate the collaboration across the broader ecosystems of clients, suppliers, and partner firms, including many of the up-and-coming fintech players. And finally, on regulations. This is often combined with an evolving regulatory landscape, and we're seeing new prudential regulations and accounting standards coming into play, as well as increased scrutiny on data. So the link between regulations and technology here is twofold. One is, how can technology actually help organizations in addressing the evolving requirements of these new regulations? And two, what are some of the implications of new regulations around the use of new technologies such as machine learning techniques, as well as alternative data sources? So all of these trends are driving significant disruption to the traditional banking model. Now, we see 5 critical areas of focus for the risk leadership. One is around the need to identify emerging and new risks. This is important for many organizations, and such new risk includes technology risk, strategic risk, talent, and so on. Second, you need to make disruptive technology part of the solution. There's always a saying you may have heard, you want to disrupt yourself rather than being disrupted by somebody else. Third, you need to define what your digital ambition and vision for risk management looks like. And this could cover everything from digital and analytics capabilities, risk organization, governance, processes, as well as talent. Fourth, you need to upgrade the capabilities of the risk function and leadership in order to achieve this vision. And finally, you need to be able to develop a clear roadmap to future-proof your risk organization. So now I'm going to spend a little bit of time discussing 1 and 2 in the subsequent slides, and I'm going to hand it over to my colleague Shika to discuss number 3, 4, and 5. So significant shift in technology has resulted in new and emerging risk and increasing the pressure on risk functions. Yeah? Now, this is by no means a comprehensive list that you see in front of you here, but just to elaborate on a few that we see many of our clients grappling with. I think technology here risk is obviously the most relevant and one of the biggest one that I'll spend a little bit of time on. As we see digital technology becoming front and center of the strategy of many of the organizations we've worked with, you can no longer rely on being well-versed in the traditional risk management approaches. So you take, for example, third-party risk. This is now becoming significant as we see our clients increasing their collaboration with third parties and vendors. And you need to make sure that you have the right risk management components in place. For example, you need to have the right policy and processes for all external spending. You need to have the right processes supported by the specialist experts where required, for example, legal and information security. You need to make sure you have the right systems in place that allows you for a comprehensive view of the bank's third-party relationship. And you need to have the right risk assessment and monitoring across the entire third-party relationship lifecycle. And this includes initial risk assessment as well as supplier due diligence. Another example of technology here that you see here is cybersecurity. I think large institutions are experiencing a growing threat. If you look at some of the statistics here, we have about 116 targeted attacks on companies worldwide registered every single day. And this is a growth of approximately 23% per year since 2010. If you look at the size of the global security market in 2017, this is about 120 billion and has grown from about 11.3% every year since 2011. So there is an increasing realization that cyber risk itself cannot be fully eliminated, and hence it's not just about the protection and prevention of cyber risk, but also around the detection and response that the risk management function needs to think about. And hence the application of very robust risk management techniques to assess and manage this risk is paramount for many of the organizations. Strategic risk. Traditional business models will lag behind the evolving competitive landscape, right? We're seeing now a lot of fintech players disrupting various different parts of the financial services value chain. And it's not really just limited to that. We're also seeing some of the largest technology players coming to this space in a very big way and offering services that traditional banks used to offer. And many of them actually have the benefits of having access to proprietary data that banks do not have, right? Take, for example, an e-commerce player. They would have the kind of information to better understand customer behavior, the products that the customer looks at, what they buy, when they buy. These are extremely useful information when it comes to cross-selling of banking products to targeted customer, because it allows these organizations to have a view in terms of what the customer needs, as well as what the risk that these customers might pose to the institution in order to extend banking products to them. Systemic risk. We see significant expansion of scope around the way big data is being amassed and utilized. Well, there are a lot of estimates out there that suggest that a takedown of a single cloud provider could result in anywhere between 50 to 120 billion of economic loss. And it comes to talent risk. We now see increasing need for increase in talent and workforce requirements beyond just the traditional risk activities. And banks are increasingly competing with the fintech players and large technology players for very similar pool of talent. And it's worth mentioning also that on the flip side, With these advancements in technology, there are also some traditional roles that could be replaced. And being able to reskill the existing workforce is now becoming a very important consideration for many of the organizations. Socio-political and privacy risk. With the use of increased use of unstructured data as well as machine learning techniques, this gives rise to the risk of social exclusions as well as privacy issues. How do you make sure that the models that you build to help you with underwriting decision does not end up picking up on those signals that ends up inadvertently discriminating against different parts of the population, such as gender and race? All of these needs to be thought through very carefully with the use of advanced analytics as well as alternative data sources. And finally, on the regulatory front, from the perspective of regulators, I think they would need to provide and evolve the way they think about technology in order to keep pace with the advancement here. And they would need to strike a good balance between pushing for greater transparency, auditability, and completeness versus over-regulating the industry and curbing innovation and growth. So just to articulate a little bit more on the type of new and emerging risk that risk managers will now need to face, and I'm going to use an example of banks in their ambition to digitize their front-end processes. Here, you can already see that there are many areas that the risk managers will need to look out for. If you look at the left-hand side, the applications moving to digital channels. This really gives rise to questions around how do you deal with new type of frauds that could happen in the digital space? How do you start to comply with the KYC requirements through the digital channel? Obviously, if you still require face-to-face interaction for KYC, this takes away a great deal of benefits from digitalization. There will be questions around how do you strike a good balance between individual review and relying on analytics to make that decision. The next point is around client servicing. There will be questions around how do you ensure that the clients fully understand the product through the digital channel and to avoid situation where you might be caught out for mis-selling. There will be questions around how do you manage regulatory requirements such as KYC without the undue red tape involved in that. New products with unknown characteristics, right? So if you take a digital deposit products, there will be questions asked around the stickiness of these new type of products, and there will be implications from a liquidity risk management perspective. If you take, for example, having capabilities for much faster and larger payments, there will be questions around how do you manage the kind of counterparty risk that's going to be involved in such a process. And today, you're also seeing a lot more of these data being stored electronically. So the impact of cyber breaches are now much greater than before, and there's also now a much greater dependency on systems. And finally, around agile development of new products here. I think here, the risk management will need to be a dynamic partner to the business. So you will need to have the right test and learn environment to facilitate the testing of new products, very quickly identifying any new risk that may be emerging, and being able to make adjustments on the fly there. So whilst we've just seen a lot of new and emerging risks from disruptive technology, and these are obviously clearly cause for concerns or cause for areas for the risk managers to be looking out for, I would like to say, well, there's also very much an area of opportunity for risk managers. Now, we've seen risk managers benefit a lot from the use of innovative technologies. And here, I would say that there are three major levers that can be applied across numerous applications. The first lever here is on data. So we are seeing the use of alternative data sources, for example, social media, telco, utilities, which can help with credit assessment and also to automate the KYC and AML processes. So when deployed in collections as well, this could be used to assess collectivity and help with prioritization of collections efforts, as well as in some instances used to support skip tracing activities. Alternative data could also be deployed in warning signals to help identify deterioration of credit risk, as well as to inform early actions. Advanced analytics. We are now seeing the use of machine learning in models for credit decision, fraud, as well as collection activities as well. And I think this, when you apply that with a wider set of data that is now readily available, could be a very powerful tool for the business. On processes, I think when you start to embed alternative data as well as advanced analytics within existing processes, this can be extremely powerful for the organization. This can reduce lending decision time frame, automation of controls around market risk, for example, being able to identify when there's significant exposure resulting from significant market swings, as well as use in the area of compliance and reporting. For example, automating transaction screening as part of AML and KYC. So all of these could translate into significant benefits for the risk functions, either through improving the productivity, example, through the automation of some of the processes, deriving greater insights from data and analytics, as well as driving competitive advantage for the business. So finally, to illustrate some of the points that I've mentioned earlier, I think I would just look at the digitization of loan application as an example of how data, analytics, and processes can be used in combination within a very core processes of the bank, right? So if you think about the traditional way of doing loan application, you typically end up with fairly lengthy KYC processes with a lot of friction points. For example, the bank may require a significant amount of documentation, such as banking statements, as well as business registration files. And some of these processes can be quite manual, right? Some of these could require a lot of back and forth between the relationship managers as well as the customer. And this could create a lot of frustrations for the customers themselves. Now, banks have typically lagged behind multiple fintechs in this regard. Right? The fintechs have been very quick to respond to these customer frustrations and automating a great deal of these processes. And now we're seeing a lot of fintechs doing very much near real-time digital underwriting. So here we see technology increasingly being leveraged by banks to support three core pillars of how these digital underwriting could help change the customer experience. The first pillar is around simplicity. How do you align the customer needs instead and digitizing a great deal of the application process? This could include the use of alternative data sources, bureau, cash flow information that can help automate the credit assessment. And this would also involve tapping into external data sources to automate processes like KYC and AML. And of course, all of these could improve the overall channel experience for the customer. The second pillar is around making sure that this is a hassle-free process for the customer. Right? So one of the things that we're seeing many of our clients thinking about is how do you pre-populate a lot of the information using customer data, either from internal or external data sources. So if you take an existing customer to the bank, coming to the bank for a new product, typically a lot of the information that you already know about the customer exists within the bank. How do you leverage technology and automation to make sure that these information are collected immediately from on the internal data sources that you have? And of course, if you have access to external data sources, how do you leverage some of these information to also pull in those information and avoid the customer having to provide too much information, or on the flip side, having the customer provide as little information as possible than to provide a hassle-free experience for these customers. And the final pillar here is around quick decision. How do you improve the decision framework that can give the credit decision to the consumer much quicker than traditionally done so? And you can see that end product for the customer could be extremely valuable. You can speed up the decision to credit, reducing the amount of days to disperse the fund. You could provide them with an online decision, as well as provide direct disbursement to their account. So I hope this gives you a good sense around how disruptive technology are changing the way the risk management needs to manage risk, and also the way you can leverage that to their advantage. So now I'll turn that over to Shikha to discuss further concretely what the risk managers need to be doing in order to prepare their organization to embrace disruption.
Thank you, Yanchu. We believe there is a clear potential. We believe there is a clear potential for digital trends to catalyze radical change. On this page, we've tried to draw out what are the key implications for the risk function in this transformation journey. Obviously, the risk functions would need to invest heavily in digital capabilities and tech infrastructure. At the same time, need to reimagine and redesign processes to include digitization. However, as my colleague Yenshu previously discussed, it's also becoming an area of regulatory focus. Basel Committee recently came out with a consultative paper that talks about implications of fintech on FS industry. It includes guidelines around changes in internal processes, of change management, product approval, to changes in operational risk frameworks to manage outsourcing. It also emphasizes the need to upgrade internal staffing and training capabilities. This brings us to the important topic on the left-hand side of the page. What does it mean in terms of risk's internal capabilities? Of course, risk needs to think through what the organization of the future would look like, which would be more flexible. The risk needs to start acting as a strategic advisor to the business. Hence, the interaction model with other stakeholders also needs to change. At the same time, the risk function is competing with the risk functions of other banks for the same specialist talent that we are now experiencing shortage in Asia. Hence, the need to partner with HR to develop attractive talent propositions and attract and retain appropriate talent has also become very important. Oliver Wyman recently conducted a survey of the CROs of the leading banks globally. As a result of the survey, it clearly came out that it is an important topic. The transformation of the risk function to be future ready is on the radar of most of the risk leadership. However, on a scale of 2 by 2 of urgency and importance, although it is important, it is still not an urgent issue. We believe that the time to start planning for the risk talent model of the future is now. It's especially important for the risk function, which hasn't been set up to be digital savvy or agile in the first place. So one of the first steps in transforming the risk talent model is thinking through what does the future state of the risk function looks like. Within Oliver Wyman, we think there are two possibilities. One is a progressive or evolutionary risk function. The other is a fundamental disruption in the risk function. In case of a progressive or evolutionary risk function, we believe majority of the value chain of risk activities would still remain in-house within the bank. However, risk would need to industrialize, streamline their repetitive or manual activities to leverage efficiency gains. At the same time, productivity gains would come from use of technology and data analytics. In case of a fundamental disruption of the risk function, we believe a large part of the value chain of risk activities would be outsourced to either other tech players or utilities. In that case, the risk function would change its role to be a more advisory, focusing on areas that truly bring competitive advantage to the bank. So what does the future target state of the risk function mean in terms of talent implications? Regardless of which target state the risk function is aiming towards, is it progressive or evolutionary in comparison to digital disruption, in both cases we see a huge change in the risk talent model. We believe at least 30 to 50% of the risk talent would require upskilling. At the same time, we think there would be a net headcount reduction of 20 to 50% in case of extreme disruption. Regardless of the future state, we believe that the risk skills would need to change and focus towards innovation, ad hoc analytics, and frontline advisory activities, which has implications on both the learning and development and the career paths that are seen within the risk talent model. Hence, the career paths would have to be redesigned. Risk functions can no longer operate in risk silos. Indeed, experience across the risk silos would probably be valued. So what does it mean in terms of the competency profile of the risk leaders? The risk leaders would be the drivers of the culture shift within the function, driving a mindset towards partnership with the business, being more responsive in governance, being more motivating and influential in terms of communication skills. At the same time, the leaders of the future of function of the risk would need to be technology savvy to identify and assess the digital opportunities. So what does the roadmap for the future-proof risk function look like? We believe the roadmap for a future risk function has 4 components. First component is to target a more agile risk function, which would include leadership stimulation, capabilities built out, and a flexible organizational model. At the same time, we believe risk leaders need to pursue no regret moves, pulling all risk efficiency levers, establishing a scenario mindset, even setting up build risk incubator lab type functions, upgrading the talent proposition, and enforcing the risk culture. At the same time, some bigger bets need to be placed. Trying to leapfrog traditional optimization with technology in at least one area. At the same time, there needs to be a portfolio plays approach where you think big and start small. From here, I'll pass on to my colleague Yenshu to open the Q&A.
Thank you, Shikhar. So I think that hopefully gives you a good sense of what are some of the trends in the area of digital analytics and technology is looking like, and what's the implications around that for the risk function. I think Shikhar gives you a good overview in terms of what's the implications for the senior risk managers in the organizations, and what are sort of next steps that senior risk organizations should be thinking about. Now, I think we'd like now to open the floor for Q&A. So, as I mentioned earlier, you can provide any questions that you have through the chat feature within video itself, and we'll try to address them.
Maybe you can also highlight some potential questions you get from clients, or if there's no questions, like what are some questions you get from your experience on this topic? Maybe just give them to us if they don't think we can. Maybe I can help you to tell if you give you some questions.
Are there any questions from this group here? Well, it looks like there is a logistic questions from one of the participants here. Can you share the slides with us? Yes. Absolutely, yes. So as we're waiting for this group for any questions here, I think maybe I'll start. Oh, look, we have a question here.
Employment levels.
Okay. Sure. Okay. So we've got some questions here. I think the first one, I guess the second one really from Angel here is around the elaboration of prediction in employment level. This is a very good question. Yeah. I think I don't have any statistics off the top of my head at the moment, but anecdotally, there has been a lot of my clients who have been talking about potential reduction in the kind of headcount that they would need within the financial services space. I think it would probably be no surprise to you. I think many of the banks have come up quite openly, suggesting that there could be significant reduction in headcount and significant reduction in the kind of branches, because a lot of the processes, front-end processes, are moving into the digital channel, right? I think I've heard, and it's probably you could find it in the news, that there are probably banks who have gone out quite publicly and say that there's potentially anywhere up to about 50% reduction in the number of branches and correspondingly the headcount as well. So that is indeed something that is quite that is not news anymore in this particular industry.
Just to pick up on the same question and elaborate further on the employment level question, the areas based on our outside-in thinking, the areas we think that would be most affected within risk would be reporting and data, underwriting, and portfolio management. The drivers for the change would be automated report production, reduced time in data gathering, usage of automated underwriting, automated limit reporting, control environment automation, and more efficient access to ALM and treasury data. These are just some of the drivers we see impacting the employment levels in the three functions that we just highlighted, where we see the most amount of impact. To the question around, can you expand on the HR and risk role? I think that's a very good question, because as we all know, that data analytics and cyber are the key areas where there is an increased talent shortage in the financial services industry, not only financial service industries, but other industries as well in Asia. And hence, there is a very important role to play in terms of the interplay of risk and HR together to define the talent proposition. I think we all recognize the traditional hiring and firing model will not help here in terms of letting go of the personnel in the areas where there is a headcount reduction and trying to hire the specialists that you need. There is definitely a more evolved talent ecosystem strategy that's required that looks at not just hiring and firing, but also redeployment. Also looks at the extended talent systems in terms of contractual labor workforce, in terms of talent sharing between organizations, social engineering, etc.
I will come back to an earlier question around, does the CRO requires good technology background and qualification? I think that's very much linked to what Shikhar has said earlier, but I think just to elaborate a bit on that, I think in short, we're seeing that people across all organizations across all levels of the organization needs to now start having some understanding of technology. They may not necessarily be the deep specialists who knows specific coding language or really worked a lot with big data, but at least a basic understanding of technology, the kind of capabilities it can bring, as well as the kind of risk that they could bring about would be quite important as well. So we are seeing also a number of very, very senior risk leaders, in fact, organization leaders, who are undergoing training in the technology side, who are getting their hands dirty on very deep getting a deep technical appreciation of what technology can actually bring to the table. I think that would really help them inform a lot of their decision at the senior level.
There's a very good question on the brick and mortar branches study. There's a very good question around, will brick and mortar branches still be needed in the future? I think this is a reality now. This is the one that we're most closely seeing in terms of workforce impact of in banking. A lot of banks in Japan, Malaysia, and Singapore have come out with targets around efficiency gains, and one of the largest lever of realizing that efficiency gains is actually closure of branches, which is leading to huge layoff in terms of talent. There are obviously policy implications of that, but policy implications aside, the question is, what is the branch of the future looks like? And I think that is a very important question. But I would say that and more important question to ask is that, what would be the customer of the future? What would that look like? Because at this point, banks are not just competing in terms of customer experience with other banks, but alternative players who are also entering into FS industry. They're competing with fintechs. They're competing with challenger banks in terms of customer experience. Hence, branch would have to be one of the many other channels which provide a holistic experience to the customer. We do see a change in terms of the retail experience moving towards more customized, personalized offerings. We see a change towards a branch which is fully self-automated in terms of a self-service kiosk. We see all those kind of models currently in place in terms of in terms of changes driven by leading banks.
So, and just to add to that, I think whilst I gave an earlier example of some of the banking institution actively reducing the number of branches out there, there are also I think this was primarily to address the fact that there are a number of traditional services handled at branch, for example, cash deposit, check deposit, and so on and so forth, are being automated. So I think in response to that, I think the need for brick and mortar branches is going down. But at the same time, there are also other strategies that we have seen some of the other banks adopt, which is really repurposing these branches. So instead of providing the traditional banking services, this could be transformed into lifestyle hubs to service the customers.
Yes.
Some of the banks have transformed some of these branches to service other needs. For example, the more attractive space in the wealth management or the SME business as well. So I think while some banks are indeed sort of moving towards branch reduction, but there are others who are also thinking about should there be actually a need for these branches to service other needs in other parts of their portfolio as well. Anything you want to cover?
This is a very interesting question. Are the future CROs IT guys? I think at the moment we are seeing an emerging trend of being able to wear multiple hats. The recent trend that we've seen is, for example, in Goldman Sachs, the chief technology officer moving into being a chief finance officer. So we do see technology skills as being important, and we do see the fungibility in movement across risk and finance to IT to be something that we would see in the future more and more.
So I'm going to pick up another question. How can the CRO identify the technology risk he knows? And let me just
He knows the basic of technology only.
How can he know the basic of technology only?
Yeah.
He knows the basic.
Yeah.
Okay, I think the question, if I understand that correctly, is how can CRO identify technology risk if he knows the basic of technology only? I think from a risk management space, I think it's whilst it's important to understand some basics of the technology, for example, what capabilities does the technology actually bring, I think there is still, going back to basic, some of the fundamental playbook of risk management that would apply as well, right? So if you take, for example, cyber risk, I think in the past, when people talk about cyber risk, there is always a function that is often viewed as a function that sits under the information security space that reports into the into technology.
Yes.
But increasingly, we are seeing a dotted line reporting from the chief information security space into both the technology as well as the risk space.
Yes.
And some institutions are actually moving that role completely into the risk space itself.
Yes.
I think what it suggests, I think, is that within the CRO space, you do need to understand technology to the extent that you can manage that. The playbook for risk management is not going to be different. You still need to have processes for dynamic risk identification, identification of new risks that's coming up, identification of new risks that could occur in new products, new processes, new policies that's coming into place. Some of the playbook remains, or the fundamental principles and tenet of risk management remains the same, but you need to make sure that you have the right appreciation of risk and also have the right talent and people within the risk organization to be supporting you on that as well. So I think it's about management of risk. I think that's important. It doesn't necessarily mean that the CRO needs to be very, very deep in technologically, but some basic of understanding, in my view, of technology will be critical.
Do
you want to pick up one then?
Okay. There's another question which is around what is the first task you would recommend me to do as a CRO and the risk that I would need to watch out for. I think it's hard to say what that one thing is, especially given the uncertainty around technology adoption and the pace at extent to which it would be adopted. But I think it is definitely important to understand what are the opportunities that exist within your risk function and across your value chain, identify those opportunities and the benefits from that. Getting internal alignment on which ones do you want to prioritize first, and launching some specific targeted pilots on that to build capabilities within risk function would probably be the first step that we would recommend. In terms of risks to watch out, I think Yenshu went through a long list of the new and emerging risks that we think are important. I would, at this point, recommend that please read the Global Risk Report of Asia Pacific Risk Center, which comes out every year and looks at the emerging and new risks in the global landscape and the priorities and implications of that.
Just to add more broadly, I think for the CRO, and if you're thinking about sort of first task to recommend, I think in all organizations, we're seeing the role of the CRO very quickly evolving. I think in the past, it used to be a question of CRO spending a lot of time on just understanding risk, being in a position to measure risk. But increasingly, we would encourage the risk organization to play a more active role in engaging with the business. So this would include, beyond just measuring risk, being able to understand how to manage this risk better, being to understand how do you actually play a role in critical processes within the bank, such as strategic planning, pricing, performance management. All of this could have very significant risk component that the CRO should be increasingly playing a role in. So in short, moving that role from just measurement of risk into more of a strategic business partner and being able to work with the business to make that risk-return trade-off. I think that's very important. Now, one strategic toolkit that we often see very important for the risk in a risk organization is the risk appetite, right? Because having a clearly defined risk appetite for the organization is quite important in setting the right tone for risk management within the organization itself, and being able to cascade risk appetite throughout the business, either to the individual business heads or through various different geographies and to country heads. I think that is extremely important because that really helps set the tone, sets the tolerance level within the organization itself. And obviously, from a risk appetite standpoint, it's important to kind of link that into the various different processes around, the planning process, link that to new pricing, approval processes. All of these kind of important processes within the bank should be governed and linked to the risk management function itself.
Okay. Yeah. I'll just pick up the question from Andre around usage of social media data and what applications we are seeing from a practical regulatory and customer perspective. I think there is a huge debate at this point, and based on our recent conferences and polls from a regulatory perspective of whether you should use social media data or advanced analytics for credit decisioning, I think there is a huge question mark. We don't see that much as of now. However, we are seeing usage of alternative data in terms of early warnings, using social media data in retail space for early warnings, using social sentiment analysis to drive early warnings for corporates. We've also seen social media data being used for collection operations optimization. An interesting example of that is from our own client is looking at the data on news items of looking at actually voice calls and doing natural language processing to understand whether it was a positive or a negative experience for the client who was called by the collection officer. And then based on that analysis, determining what is the right time to call the client and matching the client with the appropriate agent, even in populating dialer exclusion lists of clients that you would not want to call because they're not responsive. This helped in I think about 20 to 30% operational efficiency and significantly reduce the number of calls that were being made to the clients. At the same time, it optimized the collection resources towards the cases that were most responsive to this calling strategy for collections.
I would like to expand on that. I think this is also, there's a lot of interest in one of the questions around the use of social media and social media data as well as telco data, I think. I think just stepping back, I think there is definitely a lot of interest there. Some could call it hype. Some would say, well, this has been tangibly implemented as well. I think the reality, I think, as we see some of the institutions looking into social media now, telco utilities data and any kind of alternative data sources, I think some of the sort of recent anecdote I've heard is that these adds somewhat incremental value to the traditional data that's being used, right? So particularly if you're in a country where you have fairly good credit bureau information, you run a fairly tight credit underwriting process, collect relatively good amount of information for the customers, and information around income are usually quite fairly well validated. I think some of these information could be sort of incremental at best. So I think it really depends a little bit on two things, right? One is kind of the data environment that you're operating in, and this could differ across various different jurisdictions. And two is the kind of customer segment we're talking about, right? So on the jurisdiction front, if you are operating in an environment where the traditional data sources has been quite rich and reliable, typically the use of social media data would be incremental. And on the second point around the sort of type of customer that you're dealing with, I think typically this is very much applicable more for the sort of what I refer to as the thin file customers, where customers don't really have good historical bureau information. Some of these traditional data sources could be unreliable. That could be when social media as well as telco and some of these other alternative data sources could come into play. Yeah, but again, I think like I said, the use of that could differ quite a lot between jurisdiction and the customer types itself. The next session, in fact, we're hosting goes a little bit deeper into some of the use cases of these alternative data sources and the application of advanced analytics. So I will encourage you to also join the next session that we have as well.
One more question.
Yeah. Yeah, big one. So there is one. There's one question that was voted as a great question. How can you resolve emphatically the conflict of interest between using technology as a means for controlling technology risk and the fact that this probably lowers technology advances progress? Do you want to?
Really good question.
It's a good question, and I have to say that it's still early stage, but I'm not so sure if it lowers the advances of the progress. I think the biggest concern that we hear whenever we talk about technological advances in risk applications is around managing regulatory communication and whether it would be something that would be allowed. And we do see, as I said, an increased focus on this area. I think there would be potentially in future greater transparency around the balance of the benefits and the downsides of using technology, especially within risk applications, and how that could be done in a safe manner. That is definitely a very important policy question. I'm not so sure technology as means of controlling technology risk. Yes, I actually see that both of them offer an upside instead of a downside. Yeah. Because while technology is creating those risks, at the same time it helps in managing those risks as well. A good example of that would be, for example, conduct is becoming an important risk because of third parties. An incident of that was recently for a bank in India, where a third party incident led to reputational concerns around that bank using the third party around violating the rights of the individuals as customers. Hence, the question that comes to mind is that, well, we are seeing a technology also at the same time as a solution for conduct. For example, sentiment analysis could be used to manage your brand and reputation and monitor that more proactively, to see if there are in the social media or news outlets things that are picking up that show that any of the things that you're doing are affecting the individual customer mindset or even your employees negatively from a conduct perspective. So I think this is a good example of technology posing both a risk as well as at the same time acting as a solution in terms of benefit.
Yeah, I think just to add to that, I think you could look at this as if you are able to manage that technology risk better, whether you're using technology or whether it's through other means like policies or processes. I think that gives you that appetite to invest a little bit more. That gives you the appetite to actually rely more on technology if you know that the risks are reasonably well managed, to actually build, to continue building on that, right? Either from a commercial standpoint, building up the business, invest and snowballing that into increased investment within the technology space. So I wouldn't necessarily see that as an impediment towards technology advancements there. Yeah. So I think we have a few more minutes. Maybe do we want to pick on one more question and
I think the next question is, can you provide further details on the next session?
Okay. Sure. Okay. I think that one is a good segue in the next session that we'll be running. You'll hear from couple of our colleagues later on. I think that will be in a couple of weeks' time, where we will discuss a little bit more and share with you a little bit more about the use case of analytics and alternative data as well. I think the aim of that, is to really provide you with where we have seen actual cases of such technology being deployed in business practices, right? And I think that gives a very, very tangible sense of where it could be applicable. Of course, I think to caveat that, I think it may not necessarily be something that you would see that would be applicable in every single jurisdiction and every single client segment. But I think some of these use cases could give you a tangible feel around that. So that's something that we'll be discussing and look forward to discussing that with you. I think just to wrap up the session then, and apologize, I realize we didn't really get to all of these questions, but very happy to take that offline. I think we really hope this session has been useful for this group here, and I think on this page here, just to mention, Oliver Wyman publishes a very broad range of reports regularly on key industry trends. And we've shown some of the sample reports here, and we encourage you to visit our website there as well to find out more. It's worth mentioning as well that we work very closely with our Asia Pacific Risk Center, or APRC in short, which analyzes the key risk-facing industries, governments, and societies in Asia, and identify very practical ways to build resilience and realize opportunities. So we would encourage you to take a look in the website there as well. And Bring Asia is essentially the digital platform for the APRC to deliver very practical and up-to-the-minute insights that inform decision makers on the current and emerging risks. So I think we will encourage you to take a look at the website there. And a final point on the logistics, you'll all be receiving an email from the Asian Bankers Association very shortly with some of the questions to follow up on today's discussion. And so please do not forget to email your answers to us by March 6, 2018. Okay. On the next session as well, I think some of you have asked about that. The next session is going to be held on March 20th. And again, like I said, this will offer you an overview of advanced analytics and data in risk application. So thank you once again for the participation today. And on behalf of the Asian Bankers Association and Oliver Wyman, thank you for your time and goodbye.